Hi, my name is Joey Brandon. I'm the founder of Axiom Strategic Consulting. Like a lot of people right now, we are trying to help clients get through the craziness and understand what's on the other side of this. In the meantime, we have the Payroll Protection Act that was passed last week. Banks are gearing up to accept applications. You cannot apply for it right now, from what I understand, talking to several friends in the banking industry. But we are trying to understand and help clients understand how much they might be available for and what that's going to look like in terms of debt forgiveness if that's available. So here's the spreadsheet that we put together. This is just a tool. It's my take on the legislation as far as I can understand it, and there's definitely stuff in here I don't understand. So if you're out there and you got insight and you understand it better, please reach out to me. We'll make a revision. We'll give you all the kudos and credit for it. We're just trying to get this into everybody's hands so it helps. So it's pretty self-explanatory. Everybody kind of knows by now. You take your average payroll cost over the last year. We're using the most recent 12 months. You divide it by 12, and you multiply it by 2.5. Now, that includes wages, it includes vacation sick pay, it includes benefits, it includes state and local taxes. So in this example, we're coming up on a $1.3 million payroll with about $240,000 of available credit. When we look at how is that going to be forgiven, IRS is concerned, Treasury is concerned about the 8 weeks after you receive the loan. So if we say optimistically we can get this in about 3 weeks and we get funded on the 20th, we have to figure out how much we're going to spend over the next 8 weeks. So these are all round numbers because they're going to have to be estimates at this point. So let's say that we estimate we're going to spend about $181,000 in payroll costs, which is kind of defined as all these things up here over the ensuing 8 weeks. But there's also some other stuff that gets factored in here. We can be forgiven interest on debt payments. We can be forgiven rent that we pay, and we can be forgiven utilities. So when we take all of those numbers plus the payroll information, we come up with a total of $212,000. We have to back out amounts that we paid to people who make $100,000 a year or more. So over 8 weeks, that's $15,385. So anybody that earned more than $15,385, we got to back out the excess. And if you got highly commissioned salespeople or executives, most businesses are going to have some of that. So that brings our total to 204,800 that's eligible. So you can see we're already lower than where we were. Now that's probably going to be the case for a lot of businesses because a lot of them are already making pay cuts, and regardless of the government's promise to pay you back or forgive the loan, you got to anticipate that 8 weeks is probably not going to be enough to get you back to sales levels that are going to allow you to carry the same payroll you had back in February 15th. That's just the reality. So I'm telling most clients, look, if it's a fast rebound and you got specific reasons to believe that's the case, then potentially 100% of your loan could be forgiven. But if you expect that this recession that we're entering is going to take 4 months, 6 months to even kind of get a direction going where you might start to see light at the end of the tunnel, you're probably not going to be able to get 100% loan forgiven because to be viable, you're going to have to cut payroll. I say all that, but there are news reports even today that Congress is preparing the next stimulus package, already foreseeing that this is probably going to need to be more than 8 weeks of relief. But that's where we stand today. So we get into the 204,800 that's potentially available, but then there's this whole thing about FTEs, and none of the things that I've seen are really speaking to how to calculate the FTEs. So I've erred on the side of caution and built a pretty detailed FTE calculation that's based on weekly payroll. So the way that this works, your inputs go in all of these colored cells. So you basically have to decide if you had a pay period that ended between these two dates, put in the number of salary people and the number of hourly people, and then the number of regular hours in that pay period. So we're using a weekly example here. And we need to go back to February 15th of last year through June 30th. That's kind of the first benchmark period. So you put all that information in, it's going to spit out your average FTEs. And then you have to look at you get to look at a second benchmark period, which is January 1st to February 29th. When you look at that period, you come up with a second monthly average. And you want to pick the lower of the two. The lower the benchmark, the easier it's going to be able to hit it. And it's probably going to be the case that most people are looking at last year, just because they've grown since then and they really didn't start trimming back until March some in February, but most people I think are going to be dealing with a lower number last year. Then we have to look at what do we expect to have on the payroll for the 8 weeks following the loan. And this is where it gets kind of crazy. So we're saying, look, in February we had 11 people, we're down to 8. We were running about 600 hours, we're down to 4. We expect that that's going to continue to decline. And then because we're going to continue to make hourly staff cuts. And then there's going to be a rush here at the end, and I'll explain that later. So we're going to add a few more salary positions, and we're going to start increasing hours toward the end of this 8-week period. So we come up with 16.98 is what we expect our FTEs to be for the 8 weeks following the receipt of the loan funds. Now that 16.98 is quite a bit lower than our 25.11 benchmark. So we have not maintained the same employment levels. We're going to have to pay some of this loan back. However, there is a rehire provision in the legislation, and it's very, very difficult to understand. I've even included it here so that if you want to take a crack at it and see if you understand it or can make sense of it better than I have, I think this is how it's going to be calculated. So when we look at the rehire, what IRS is saying is, look, if you let people go between February 15th and 30 days after this legislation was passed, and that kind of makes sense because they passed the legislation, but it's going to be a minimum of 3 weeks before people start seeing the cash, right? And they want you to use the cash to hire people back. So if you let people go from February 15th to 30 days after the legislation became law, and you rehire those people or you replace those people by June 30th, we're not going to count it against you. So the way that the calculation works is it says, how many did you let go? So we let go of 8.65. We're anticipating that on that June 30th pay period, we're going to have 20 FTEs back on board. So the difference between the 17.38 and the 20, we added 2 more back. So we get to say, hey, we added 2 back, don't count that against us. We let go of 8, but we added 2 back. So give us credit for the 2 back. So that's what we're doing here. We're adding the 2.62 to the 1698, and we're coming up with 19.6. Now 19.6 is 22% lower than our benchmark of 2511. So that's where the 22% reduction in loan forgiveness comes from. It leaves us with about $80,000 to pay on this loan, or $800 a month over 10 years at 4% interest. So if you have questions, if you see improvements to it, you want to shoot it to me. If you have resources you want us to get out or you'd like to share with us, we welcome them. But we hope to hear from you soon. If you have questions, please give us a call.